Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
Hey everyone, welcome to the 15-Minute Financial Feast. My name is Mark Triplett.
And I'm Troy Westendorf.
Today we are going to be talking about actually 10 transitional or milestone birthdays beginning at age 50. Now this is a two-part series. There are so many to cover that we aren't going to be able to cover all of them in one 15-minute session. So we're going to break this into two. The first session will cover the transitional birthdays beginning at age 50 through age 63. And then the second one will break down those from 65 to 72. And I want to make sure we make a quick point here that a lot of folks will have a lot of different transitions throughout their life. Okay? You have a transition when you graduate from high school, for example, and maybe go off to secondary school like college or trade school or even just right into the workforce. That's a transition. Maybe you buy your first home. That's a transition. You get married. That's a transition. You start a family. That's a transition. We're talking specifically, though, about birthdays that have transitional milestone moments associated with them, many of which are tied in with tax code.
Yes.
Okay, so we're gonna start there with the transitional birthdays beginning at age 50 through 63, and Troy, the first one at age 50. Let's talk about that one just for a moment.
Yeah. So first one at age 50 is. Now we can make catch-up contributions to our qualified retirement plans, such as IRAs, 401ks, Roth IRAs. And as qualified, we can now start making what the government says is a catch-up.
And those catch-up contributions vary from IRAs to workplace plans like 401ks. There are different limits. And there's even some tax legislation that's being floated right now that could change that and increase them. But right now, they are what they are, and at age 50, that's kind of when those catch-ups begin. And it's really important to be aware of them and then understand what the limits are. And if you do need to save additional resources for retirement, that's why these catch-up limits exist, to help folks catch up, that they begin at age 50. Now, at age 55, you can take early retirement withdrawals from your 401k and avoid the 10% penalty. So this is a very important milestone age for folks who might be planning on retiring early. At age 55, that is the point in which you still have to pay taxes, but you can avoid a 10% early withdrawal penalty from distributions made out of your 401ks. If you have money in an IRA, for example, you're still going to be subject to that 59.5 rule. So this is one of the reasons why sometimes it makes sense to leave some money in a 401k instead of rolling everything to an IRA. But that is one of the milestone ages. We've got to stress that federal taxes and state taxes still apply. You don't get to avoid those, but you can avoid that penalty for early withdrawal. And Troy, what's the other reason that age 55 is important?
You can make those catch-up contributions to the health savings account.
That's right.
Don't talk a lot about that, but that's actually another bonus, really.
Yep. So unlike the age 50 milestone for catch-up contributions for your IRAs, Roth IRAs, and other qualified accounts, your HSA or health savings account, that catch-up age is 55. So once you reach age 55, you can actually put in additional dollars to your HSA or health savings account. And you might want to do this if you are planning on carrying a balance into retirement, because your HSA dollars can be used for healthcare in retirement. For example, Medicare premiums. You can pay your Medicare premiums out of HSAs, or long-term care insurance, or you name it, a host of different things. Dental work, things like dental and vision that are not covered by Medicare in retirement. Might want to have an HSA balance that allows you to distribute those dollars tax-free to be able to cover some of those costs. So if you have an HSA and you're taking advantage of it, know that at age 55 you can do catch-up contributions. Now, 59 and a half is a pretty big milestone age. So let's talk about age 59 and a half.
Yeah, 59 and a half. So the IRS permits us to do in-service rollovers. So what that means is we can now take from our employee-sponsored plan, which your 401k, we'll just call that to make it simple, and we can actually transfer that into a self-directed IRA, which means now we can have control over what we're doing with those 401k proceeds. So that's a pretty big deal. Not all plans allow it, but we're seeing the majority of them do.
Yeah, so the IRS allows it, but your plan document of
say different.
Of your 401k plan might actually have a different age at which you're allowed to do in-service distributions, but many of them today have either been set up with that milestone age or have been amended to allow in-service rollovers at age 59 and a half. And so it really just opens up the world of investment options at that point and allows you to diversify out of your 401k and to do much more critical planning as you near that transition from your working years to your post-working years that we all call retirement. And as a result of those in-service rollovers, now you can do some potential Roth conversion strategies as well. Because when you take those dollars out of that 401k at 59 and a half, you're not necessarily retired at that point. Maybe you're still planning to work for a few years, but we might want to do some strategic Roth conversions to get some of those IRA dollars converted over to never taxed Roth IRA dollars.
The other thing we can do is now we can take a 10% penalty-free withdrawal. So we don't have any, not penalty-free withdrawal, a 10% where we don't have to pay any tax on there. So now we can take IRA distributions and not pay that 10% penalty.
Yeah, prior to age 59 and a half, you're going to have a 10% penalty on those distributions from an IRA. You're still going to have to pay taxes on it, but after you reach 59 and a half, you are now considered to be retirement age as far as the IRS is concerned, and they're not going to penalize you for taking withdrawals, so you can avoid that 10% penalty.
So we've hit the prime age of 62 now, Mark. What are the options we have now? So
at age 62, you're now permitted to file for your eligible Social Security retirement benefits. For most folks, that's the earliest age at which they can claim Social Security. It's the earliest age at which you can claim Social Security on your own work history. I won't get into all the details on widow benefits and things like that, but for most folks, age 62 is going to be the first time where you can actually file for Social Security benefits on your own record. That doesn't mean you necessarily should. Claiming prior to full retirement age will result in a permanent forfeiture of benefits, as well as the cost of living adjustment that you would have otherwise received on those forfeited benefits. So it doesn't always make sense to claim at 62. However, what's the most popular age to claim? Age 62.
Right.
Oftentimes, folks have to because they don't have the resources. But a lot of folks just claim at 62 based on more of emotional decisions. They think the program's going to be gone. There's not going to be money left. I'm going to get while it's good. So they are willing to permanently forfeit 25% or more of their benefits and the cost of living adjustments they would have received on those gone forever. You're also subject to the earnings limit at that point too. So if you claim prior to your full retirement age, and your full retirement age is based off of your date of birth, if you claim between 62 and your full retirement age and you're still working, you're going to be subject to what's called the earnings limit. Troy, will you explain the earnings limit a little bit?
Yeah, so the earnings limit, basically, so if you're out, let's just say you're working a part-time job, a lot of times we have families that will want to go out and work and think, well, I can claim my Social Security benefit and work, and I'm just going to have this extra cash coming in. But the government or the IRS says we can only earn so much, and I think that's around 18,000, just over 18,000.
Yeah,
it changes
every year. It goes up a little bit. It's just shy of 19 now because it's increased. But if you make more than that earnings limit, and this is stuff that we look up, so I don't carry it in my head.
Yeah.
If you make more than that earnings limit, they're going to claw back $1 for every $2 you make. So we've had this occur before.
Yes,
Somebody turned 62,
Yep.
and they're making, say $40,000 a year, making a decent income.
Yep.
And they say, well, I want to claim early because I want to get it before it runs out. Well, that person's not even going to get a check at that point because they make more than the earnings limit. Their Social Security benefits going to get eroded by this clawback of their benefits. Now, it's not like they vanish forever; they get recalculated later on. But it doesn't make any sense to go file for benefits when you're really not even going to get any check from it because you make too much.
Yeah, it makes much more sense to just delay the claiming.
Yeah, exactly.
So we have age 63 coming up, Mark, and this is a Medicare topic, which happens at 65. So what is the importance of age 63 when we can't claim benefit till 65?
Sure. Well, that's a great question. What the heck does age 63 have to do with Medicare? Like Troy said, you become Medicare eligible at 65. Why does 63 matter? And the reason age 63 matters is that year that you're age 63. That's the tax year that is going to be used to determine what your Medicare premiums are when you turn 65. They're always looking 2 years in arrear. So
Medicare premiums aren't the same for everyone?
Well, that's going to bring that topic up, huh? So, no, Troy, not everybody pays the same Medicare premiums. Some folks have to pay a surcharge or an additional, you call it tax if you want, but higher premiums called income-related monthly adjustment amount, or IRMA. And if you have an income that exceeds a certain threshold, or you and your spouse together filing jointly have an income that exceed a certain threshold, you can end up paying surcharges on your Medicare premiums. Now, let's say that you and your spouse have a great income. You're exceeding those limits at age 60, 61, 62, but you're not filing for Medicare, so it doesn't matter. 63 comes around, you're still working, you're not planning on retiring until 65, and you're doing great, and you're making great income, and then you retire at 65, and all of a sudden you get this notice that your Medicare premiums are significantly higher than they would have been for everybody else. That's because they're looking back in time, 2 years in arrear, when you were 63, and seeing that you made significant income. And because of that, you're hitting one of the tiers of IRMA, the income-related monthly adjustment amount. Now, there's something you can do about that. There's a way to notify Medicare that you had a life-changing event, in this case, retirement, and get that amended. But I can't tell you how many times we've run into it where folks are paying unnecessarily these Medicare surcharges because they didn't know. Or had they done some strategic planning with regard to their income 2 years prior, they could have avoided having those Medicare surcharges altogether. So 63 is a key age because of that income, or your modified adjusted gross income that year has an impact on what your Medicare premiums are going to be. So that's it for our show this week. As we mentioned, this is a two-part series.
We'll have 5 more to come on our next series with the 5 transitional birthdays. We'll do the next 5 on our next one. Until then, though, if you have any questions about the topic, you can visit www.mypt5.com, the number 5, or you can reach out to our office and get some time set with us, and we'd be happy to walk you through any questions you may have.
You can be a hero to someone. Somebody out there right now who might be struggling with how to tackle some financial issue that is really bothering them, and just let them know there are folks out there that can help them. They don't have to go at that alone, and to seek out a financial professional that does comprehensive retirement planning, like a firm like us, and get some help. I'm your host, Mark Triplett.
And I'm Troy Westendorf.
We're serving up some bread for the head. Every dollar has a purpose.
Every dollar has a timeline.
Until next time, be sure you're taking steps to retire with purpose.
And on time.
You've been listening to the 15-Minute Financial Feast podcast, Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.